So I spent the last week or so taking a little bit of time off from the stock market, skiing and snowboarding with my family, but it also gave me time to go a little bit deeper on research, kind of taking a step back, I guess is the better way of putting it, on the global economic cycle, where we are in risk assets and so on and so forth, and just kind of lining up some bigger picture thoughts and charts. And it all came back down to bond yields. I really think that bond yields here are essentially about as high as they can go, and this is very non-consensus. I'll show you the most important chart I think there is here in just a minute on our screens. But I just want to make this point real quick. If you look at where we are in the global economic cycle, bond yields probably can't go a whole lot higher. But there's another dynamic to all this which is unbelievably important. And by the way, let me just quickly show you the chart and then have a very exciting announcement for our spring stock and options summit that's going to take place probably in Phoenix. But let me first show you the chart and then make a couple of really important points so this all makes sense to you. So what we're going to do first is look at the chart of the 10-year US Treasury note yield. Okay, this is yield, not price, and the ticker symbol for this is TNX. You can see it right here, TNX, in case you care. And what we have on the top part here is essentially yield, right? So this is the yield from about the mid-80s, 1980s, mid to latter part of the 1980s. You can see we've basically been in a very steady downward move in bond yields, series of lower highs and lower lows. Yes, we've marginally broken out here, and I think this is something to respect. But ultimately, we're also at that 200-month moving average. That's a red line on your screen. This red line here is the 200-month moving average. These are all monthly increments. This is a long-term chart. Now, looking at one more thing on the chart before we're looking at some structural stuff. At the bottom here, what you have is momentum, and it's a very simple, what's called a MACD, moving average convergence yield chart. Momentum chart. Representing price yield. And you can see every time we got to the upper end of this range here, where we still very much remain right now, I may not be able to see it in exact detail, but we haven't really, the last time we got about to this level was in the probably 93, 94, 95, somewhere around there, maybe 94, 95. That's where bond yields topped once again. Then they tumbled from significantly from almost 8% maybe down to ultimately down to below 4%. Yeah, so they were cut in half, and so I actually really think we could dramatically go lower in 10-year bond yields. And just so you know, and this is really interesting to note, so this is totally non-consensus. I started making this call in the summer of last year, 2018. And as I made that call, I remember getting emails, and it must have been a few dozen emails that I personally looked at. A lot of it my support team handled. But I remember reading at least a half a dozen emails saying from people that are very angry about my call that I think bond yields are about as high as they can go. And they ultimately actually unsubscribed. And they literally said that I'm unsubscribing because I think you're totally wrong. Well, bond yields have gone from 3.2% back down to 2. They were down at 2.7, 2.8%, something like that. So, I mean, that's a big move in bond yields, and I think we can go a lot lower. Now, this is just the charts, right? But let me make one more really important point, because I think a lot of people spend too much time or too much emphasis on bond yields in terms of charting or bond yields in terms of as it relates to the economic cycle. And yes, I do think from an economic cycle perspective, we're probably at a point where bond yields in the US can't go much higher. I think they have to come more in line with what we're seeing around the world. Japan and Europe, where they're closer to zero. I'm not suggesting we're going to zero, but I think they can go a lot lower. But I want you to think about this through the lens of an allocator of money if you're a baby boomer, which a lot of you that are watching this probably are. The baby boomers are still the largest pool of capital aside from institutional money that allocates capital to bonds and to hedge funds and all those kind of things. But they're getting more and more conservative as they're reaching, and some of them are already quite a bit into retirement age. So to them to allocate capital to the bond market here when the 10-year bond yield yields between 2.6 and 2.8, maybe even north of that percent, and the 2-year bond yield is like yielding around 2.5%, is kind of a no-brainer. So this structural decline in bond yields that you saw on the chart that I showed you back here is I think is I don't know if epidemic is the right word, but it's structural, right? And so yes, of course, the economic cycle has to do with it within the range, but ultimately, if people are searching for yield in a more conservative manner, they're going to look for capital allocation. So my call here is that this is the most important chart. I think that bond yields are going to go lower, both on the short end and on the medium and long term end, so pretty much across the curve in U.S. yields, and that ultimately will have reverberations around the equity market as well. So I know not everyone focuses on bond yields at home, but I think this is a really, really important chart, and for what it's worth, it's the most important chart for me. Certainly, we reserve the right to change our minds on that, but for right now, all else being equal, I think bond yields will continue to see pressure and go lower for the foreseeable future. If you have any questions or comments, please leave them down below. And and the Arizona thing, right? So we're working on our springtime stock and options trading and investing summit. It's most likely going to take place in April, in the end of April, most likely in Phoenix, Arizona, or Scottsdale actually. Phoenix, Scottsdale, yeah, in that area. And we're just finalizing it right now. But if you are interested in it, if you want to indicate early interest, we're not taking names, but just so we kind of know, leave a comment down below or send us an email, support@thesteadytrader.com. We'll let you guys know more about this, and hopefully in the coming days as we start making it all glossy and shiny for everyone to sign up. So that's end of April, Phoenix, Arizona, our springtime stock and options trading and investing summit. Looking forward to seeing you guys there, but again, we'll have the official registration page out in the next few days. Take care.